The stock we're going to look at today is Lincoln Educational Services with ticker symbol LINC. Lincoln Educational Services is a provider of career-oriented post-secondary education. They have 45 campuses in 17 states with offering degrees in health sciences, automotive technology, skilled trades, and business and info technology. The company's brand name schools include Lincoln Technical Institute, Nashville Auto Diesel College, among others. This may be considered a more risky investment than some of the previous posts due to the industry they're in, as well as them being a small cap stock. However, we'll get into the specific risks later. The quote from Friday was $7.79. Here we see the earnings per share for Lincoln for the last several years, which allows us to determine that the 7-year average PE is 6.96, while the 3-year average price to earnings ratio is an even more attractive 4.34. So some other numbers to consider are the return on invested capital for the most recent year, 12.4%, while the 5-year average return on invested capital comes in at 16.1%. The current dividend yield for Lincoln is 3.59%. If we look at the book value of Lincoln, we're actually able to see that that Lincoln is trading for less than book value currently, with the price to book value ratio coming in at 0.78. The industry average is actually 2.1. The industry average PE is 14.7. As far as the financial health for Lincoln, the debt to equity ratio is 0.2 versus the industry average of 1. So due to the metrics shown here, the price to book value as well as the PE ratios, Lincoln definitely looks interesting from a value perspective. However, as we can see from this chart, there's definitely been some negative sentiment towards the industry in general, and specifically Lincoln recently. This is mainly due to the government scrutiny, specifically the Department of Education regulations passed last year. One example is that at least 35% of former students must be paying down their loans and spending less than 12% of total income on payments. This will likely require adjustments to the admissions process for these for-profit schools. But considering the current PE ratio that we saw in the previous slide, and the fact that they're trading for less than book value, it seems like the price decline is overdone, and that the risk to reward ratio is starting to look interesting. Considering the recent negative performance, and actually looking over the past 5 years, the returns on Lincoln don't look too good. However, Lincoln used to be trading with the PE ratio as high as 31, and definitely much more pricey than where we are now. Hence why they are starting to look interesting for a value investor currently, coming down from the lofty prices of the last several years. One other thing to consider is that they are announcing earnings next week, so of course this could be a volatile time depending on the results, and will likely result in could likely result in a significant move one way or the other. So if you want to consider waiting till after the earnings announcement to see if they are at even more of a bargain price, that's an option. Looking at this chart, we can see from the RSI as well as the slow stochastic that Lincoln is definitely already in an oversold position. But mainly looking at the PE ratio as well as the fact that they're trading less than book value and that they don't have excess debt and the financial health looks reasonable, Lincoln seems interesting at this time. So that sums it up for this edition. Remember to check the site here for the next post. Thanks. Bye.